And thank you for joining me. I'm Don Ma. Just a quick overview of markets today. Wall Street's main indexes closed flat on Thursday, giving up most of early gains on milder than feared inflation data. More on that later. But investors are worried about the U.S. economy's longer-term prospects and whether stocks had further room to run. In the first hour of trading, the three benchmark indexes advanced more than 1% as traders bet the U.S. Federal Reserve would stop further monetary tightening in 2023 and start cutting interest rates early next year. Stock prices started to sag from late morning onwards and bounced between positive and negative territory for much of the afternoon. S&P 500 gained 1 point, mostly unchanged. NASDAQ gained 16 points or 0.1%. Dow rose 50 points or 0.1%. Seems like more and more Americans are failing to make payments on their credit card and auto loans. A report from Moody's Investors Service this week indicates delinquencies of at least 30 days are past pre-COVID levels. It shows new credit card payment lapses rose 0.7% between the first and second quarter. For recent auto delinquencies, that increase is 0.4%. The numbers are still below the levels of the Great Recession, but they're a sign Americans are struggling to keep up with high prices. So from car loans to credit cards, a new consumer credit report shows Americans' credit card debt is at a record level, hitting $1 trillion for the first time ever. So what can you do if you're struggling to pay off debt? Here's a look at 3 tips to help you get back on track.
Americans' borrowing habits reaching a historic milestone. For the first time ever, credit card debt levels have surpassed $1 trillion. That's according to data released Tuesday by the Federal Reserve Bank of New York.
What we're seeing here is more people carrying more debt. The New York Fed says credit card balances are at a record high for longer periods of time.
Meanwhile, a new bank rate survey finds 47% of U.S. credit card holders are currently carrying credit card debt month to month. It comes as interest rates have soared to levels not seen in over 2 decades.
The average credit card charges about 20.5%. So there are definitely some worrisome signs there.
Ted Rossman, senior analyst at Bankrate.com, has 3 tips for people holding a lot of credit card debt. 1, try the avalanche method. List your debts from the highest to lowest interest rate, make the minimum monthly payment on each, and then invest all your extra cash toward paying off the highest interest debt. Repeat until you've paid all your debts down. 2, consider a zero balance transfer credit card. It allows you to transfer your existing high-cost debt over to a new card and pauses the interest clock for up to 21 months.
For those 21 months, the ability to avoid interest is really powerful. That could save you hundreds, maybe thousands of dollars, depending on how much you owe.
And 3, get your spending under control. Bankrate suggests focusing on basic necessities and obligations and delaying major purchases like cars.
And more Americans are making emergency withdrawals from their 401k retirement plans to cover financial emergencies. This is according to a recent report on Americans' finances as inflation remains high. A recent Bank of America report says millions of households are increasingly relying on their savings and racking up credit card debt to pay for necessities. The study analyzed 4 million employee accounts with the bank nationwide. About 16,000 workers with employer-sponsored 401k plans made a hardship withdrawal in the first quarter of this year. And President Joe Biden on Wednesday signed an executive order that will prohibit some U.S. investments, some new ones, in China in sensitive technologies like computer chips, and it's going to require government notification in other tech sectors. Here are the details.
I'm paying attention.
U.S. President Joe Biden signed an executive order banning certain U.S. investments in sensitive technology in China on Wednesday, a move that risks fueling tensions between the world's 2 largest economies after the White House has tried to stabilize ties with Beijing. The investment ban focuses on semiconductors, quantum tech, and artificial intelligence, areas where the U.S., Japan, and the Netherlands have dominated and where China has worked to develop homegrown alternatives. The order aims to stem the flow of U.S. capital to tech like that, which could also boost China's military modernization. Biden sent a letter to Congress declaring a national emergency over the issue, and hours earlier spoke to an audience in New Mexico emphasizing domestic investment.
We're continuing to make progress in fixing the supply chain. For example, We couldn't access semiconductors during the pandemic because the factories making them overseas were shut down. You all know semiconductors are those little small computer chips about the size of any fingertip that affect nearly everything in our lives.
It may take many months before Biden's order comes into effect, possibly not enacted until well into 2024, a presidential election year. The White House said Biden consulted allies on the plan and incorporated feedback from a group of 7 nations. The administration also said the controls will apply to narrow subsets of the 3 areas and they will not be retroactive. The Treasury issued an advance notice on the rules, saying some deals would be banned once the regulations kick in, and investors must notify the government of their plans on others. The restrictions will also apply to Hong Kong and Macau, both separate customs territories from China. China on Thursday said it is gravely concerned about the order. A Commerce Ministry statement criticized Washington of, quote, artificially hindering global economic and trade exchanges and cooperation or set up obstacles for the recovery of the world economy. The Chinese Foreign Ministry said it lodged solemn representations with the U.S. It said the country was strongly dissatisfied with and resolutely opposes the U.S.'s insistence on introducing investment restrictions on China.
And current oil production in the U.S. could shatter the all-time record set 4 years ago. Government estimates released Tuesday project American oil output could hit an average of 12.8 million barrels per day this year. For the first time ever. That's about 500,000 barrels per day more than the annual record set in 2019. And if that's not enough, next year they say U.S. oil output is projected to climb to 13.1 million barrels per day. And Walt Disney has created a task force to study artificial intelligence and how it can be applied across the entertainment conglomerate, even as Hollywood writers and actors battle to limit the industry's exploitation of the technology. But Disney isn't the only company. Here's more.
From why Mickey Mouse is getting artificially intelligent to how fake music could go legit. This is Generation AI. Early adopters have been trying out WorldCoin in countries including Mexico. Participants get their irises scanned to create an ID proving they're not an AI bot. Privacy campaigners are horrified, but they shouldn't be, says Sam Saddle from Tools for Humanity, the firm behind WorldCoin.
The point of the iris biometrics is simply to confirm that you are human, that you are alive, and that you are unique.
Apple is spending big. Its latest earnings revealed an extra $3 billion in research costs. Much of that went on generative AI, the same tech that is driving spending at rivals. Mickey Mouse has caught the AI bug too. Sources say Walt Disney has set up a task force to study how it can be applied to everything, from movies to theme parks. That may not go down well with striking writers and actors, who both see AI as a threat to their livelihoods. The tech is shaking up music too. Nigerian producer Eclipse Nkasi has used AI to make a whole Afrobeats album.
We have a fair chance of actually creating music that matters, because there are tools now that you can impute, you can guide, and ultimately it would interpret the ideas that you have.
And that could just be the start for the industry. The Financial Times says Google is in talks with Universal Music to license artists' voices and melodies for use in AI-generated songs.
And it seems like living in the Big Apple will take a bigger bite out of your wallet. The median cost for rentals in Manhattan reached $4,400 last month. That's according to the latest information from the Douglas Elliman Brokerage and the Miller Samuel Appraisal and Consultant firm. The report says this is the third record-setting high rentals have seen in the last 4 months. While the monthly bill for renting is going up, the incentives from landlords are doing the opposite. Rentals have also risen in other parts of New York, including Brooklyn and Queens. Miller Samuel says leasing activity has decreased in general, not from a lack of supply, but rather a lack of affordability. And another story on Disney. Disney CEO Bob Iger acknowledged that the entertainment company faces a challenging environment in the near term on Wednesday. But he emphasized progress in cutting costs and focusing on creativity. Here's more.
Disney announced price hikes for its streaming services on Wednesday, as CEO Bob Iger admitted the company faces what he called a challenging environment. The ad-free version of Disney Plus will cost $13.99, a 27% jump starting October 12th, while no ad Hulu will go up 20% to $17.99. In a bid to try and usher in new customers, Disney said it's also rolling out ad-supported streaming to Europe and Canada. And Iger says next year, the company will address password sharing, echoing Netflix, which cracked down on it this summer. It all came as the company reported quarterly revenue that fell short of what Wall Street expected at $22 billion, but delivered profits to investors that were better than expected, according to Refinitiv. The company said it's on track to keep up a cost-cutting drive aiming to slash $5.5 billion it promised investors earlier this year. The company's direct-to-consumer business, including streaming, saw an uptick. Disney's theme parks and resorts also saw a bump, thanks to its park in Shanghai rebounding now that China's health crisis restrictions have loosened up. Meanwhile, after Iger sparked anger last month, telling striking Hollywood actors who were demanding for higher pay and limits on the use of AI that their demands were not realistic, on Wednesday he signaled a shift in his position. In a revenue call, he said, quote, "Nothing is more important to this company than its relationships with the creative. I have deep respect and appreciation for all those who are vital to the extraordinary creative engine that drives this company and our industry." Reuters reported on Tuesday that Disney has created a task force to study AI and how it can be applied across the company. Contract talks with writers have stalled, and people on the picket lines told Reuters they were protesting a disregard for their demands.
And the price of your morning glass of OJ is going up. Analysts say orange juice futures are hitting record highs because of bad weather, citrus disease, and short supply. Prices usually hover around $1.80 per pound, but futures soared to $3 a pound. Most orange juice comes from Florida, but last year's hurricanes along with the late freeze took out a large amount of crops. And a disease called citrus greening is also wiping out orange trees. The USDA predicted a decline in production of about 51% this year. And the Hollywood writers' strike has hit 100 days with contract talks stalled and people on the picket lines protesting what they describe as a disregard for their demands. Here's more.
I think they wanted to wait us out. They wanted to starve us out. And I think they wanted us to be broken.
Hollywood writers marked 100 days of striking on Wednesday, with contract talks stalled and people on the picket lines still protesting what they describe as a disregard for their demands. The 100-day mark means this strike has now lasted longer than the writers' strike of 2007 to 2008. And the feeling among protesters is decidedly different this time around, says writer Ian Deachman.
I am so blown away by the solidarity that I feel out here and the strength. And I hope that the companies are starting to realize that, like, the longer they make us walk in the heat, the angrier we get and the stronger we get, not the weaker.
The strike began on May 2nd. After negotiations between the Writers Guild of America and major studios reached an impasse over issues including compensation, minimum staffing levels, and residual payments in the streaming era. Writers also sought to regulate the use of artificial intelligence, which they fear could replace their creative input. Picketers outside Netflix said they were undeterred by the length of the strike. This is Celia Finkelstein.
You can't break people who have already chosen a job where we're told no 500 times a day. We chose a hard job because we're resilient and because we love it.
Entertainment industry executives have been trying to navigate the crosscurrents of declining television revenues, a movie box office that has yet to return to pre-COVID levels, and streaming businesses that are struggling to turn a profit. Actors represented by the Screen Actors Guild also went on strike on July 14th, also over pay and artificial intelligence, effectively halting production of scripted television shows and films. It is the first time both unions have gone on strike since 1960. Evan Shafran is a SAG-AFTRA member and MC at Netflix.
We believe so much in fair pay and fair contracts, and not being exploited by these companies.
A meeting last week to discuss resuming talks between the Writers Guild of America and the Alliance of Motion Picture and Television Producers, the group representing the major studios in negotiations, resulted in no firm date for returning to the bargaining table. The WGA did not respond to requests for comment for this story, and the AMPTP declined comment.
Novo Nordisk's limit on U.S. supplies of starter doses of its hugely popular Wegovy weight loss drug will last into next year, even as the Danish drug maker spends billions boosting output, its CEO told Reuters on Thursday. Here's more.
Novo Nordisk is extending curbs on U.S. supplies of its hot weight loss drug Wegovy. The Danish firm announced the move Thursday, after saying earlier in the year that it was struggling to meet demand. In May, it said it would halve supply of starter doses to ensure it had enough for patients already on the course of medication. Thursday's news came the same day as Novo Nordisk again lifted its outlook. It raised its profit and sales forecasts for a second time this year. The company now expects operating profits to grow by as much as 37%. Novo Nordisk is riding soaring demand for Wegovy. It's a weekly injection that can help people shed 15% of their weight in conjunction with diet and exercise changes. The product has turned Novo into Europe's second most valuable company, behind only luxury titan LVMH. On Thursday, its shares were down over 1% in early trade, following the warning on supplies.
And of course, life is expensive right now as inflation backs off decades-high peaks and interest rates drive up the price of loans. And many households are just trying to keep up. It's taken a toll on credit card balances and retirement accounts. Here's a look at the numbers.
Two new reports illustrate the toll of nearly 2 years of elevated inflation on households. The Federal Reserve Bank of New York said Americans' credit card debt passed the $1 trillion mark for the first time during the second quarter of this year. Overall household debt, which also includes mortgages, auto loans, and student loans, has climbed $2.9 trillion since the end of 2019, before the COVID-19 pandemic. And higher interest rates, the Federal Reserve's key tool to curb inflation, will make it harder to pay those debts down.
When interest rates rise, the debt that people hold gets more and more expensive, and that's certainly playing a role along with inflation and a few other things.
A second report from Bank of America found a surge in the number of Americans making emergency withdrawals from their 401k accounts. Another sign households are struggling to keep up. But households do have a strong labor market and easing inflation in their favor right now. Matt Schultz, chief credit analyst for LendingTree, says if consumers can, they should make debt payments a priority to protect finances for the future.
When you're in a situation like that, about the best thing you can do is knock down that debt that you have as soon as you can. It's a lot easier said than done when life is so expensive in 2023, but it's a really important thing to do.
And of course, new CPI report out today, and for the first time in a while, inflation ticked up on an annual basis. Here's a look at where and why consumers are still feeling the squeeze.
A bump along the Federal Reserve's road to a target inflation rate of 2%. The Bureau of Labor Statistics said Thursday the Consumer Price Index rose 3.2% year over year in July, its first annual uptick in 13 months. Economists say there's more to that year-over-year figure, which is a far cry from a 40-year high of 9.1% hit in June 2022.
Well, it is not quite mission accomplished yet, but a significant progress on the inflation front has been made.
Housing costs remain stubborn, up 7.7% from 1 year ago and pushing the overall annual index higher. The report said shelter costs accounted for the bulk of a month-to-month increase in overall consumer prices of 0.2%. With the housing market still coming down from its screaming pandemic-era highs and feeling the pressure of the Federal Reserve's interest rate hikes to curb inflation, economists like Sungwon Son of Loyola Marymount University expect a turnaround in shelter costs, especially the rental market, ahead.
Sooner or later, we will see rents declining, and that's going to bring down the inflation rate quite a bit.
Energy and food also saw slight upticks from June to July. Items like beef, apples, and coffee cost more, eggs, chicken, and milk a little bit less. And airline fares and used cars and trucks were among other areas that saw decreases.
And here with me to break down the CPI report is Sam Burns, Chief Strategist at Mill Street Research. So Sam, I was thinking maybe to start off, maybe give us some notable contributing items in today's report.
Yeah, the CPI report today was basically in line with consensus expectations, and probably the biggest thing holding the CPI, and particularly the core CPI, up still is the owner's equivalent rent, or the housing component. That's contributing probably 80–90% of the overall rise in the CPI for the month, and so that's really still a key factor. But we know that that's a kind of a lagged measure, and will probably continue to come down in the coming months. So overall, it's a fairly reassuring report in that everything except for housing is pretty moderate right now, and actually close to a zero inflation rate.
What about energy? Gas prices seems to be ticking up a little bit at the pump recently.
That's right. Yeah, we've seen oil prices and gas prices start to tick up lately. That didn't show up in this report, but it probably will show up in the next month or the month after report. We'll probably see an uptick in the energy and gasoline prices. So they've been down some before, so this will be sort of a rebound. I think the general trend for oil prices is probably still going to be kind of in a range. So my guess is that it won't be a persistent trend, but it will be a rebound in the next month or two.
The EIA actually projected recently that oil prices could be closer to $90 a barrel by the later of this year. I mean, do you think that will have a material impact on CPI?
It could, yeah, and certainly on the overall level of the CPI, meaning not just the core rate, which excludes energy. But yeah, I think there is a potential for a rebound in energy costs. The question is, will that be offset by the continuing decline in the housing component, which is a much bigger percentage of the overall CPI's weight? So my guess is that there will be some offsetting factors there. I think the housing costs will continue to be muted, and other things, automobile prices and other factors like that will probably continue to weaken. So it may offset some of what we see in a rebound in energy costs.
Yeah, one of the biggest components is housing, and we could see a downtick from that. But let's address the headline for a bit. What do you think contributed most to the slight uptick in the headline inflation number?
Well, yeah, the overall year-over-year headline inflation number ticked up from 3 to 3.2, mostly because the month that we dropped out of the 12-month calculation from a year ago was very low. So even the 0.2% that we got this month, which is a pretty moderate reading, was higher than the month that we dropped out of the calculation. So that means the year-over-year figure goes up temporarily. But I think the overall trend, and certainly the last several months, show pretty muted readings for the overall CPI. And so I think the general trend is still lower, even if we did see an uptick this month, just because of the noise in the monthly data.
And of course, the market's still convinced that we're in a downward trend for this inflation battle.
Generally speaking, I think that's right. I think bond yields are generally expecting inflation to continue to come down. Most of the market pricing now shows that they do not expect the Fed to raise rates in September. There might be another one later in the year, but that's still uncertain. So I think the worry about the Fed in terms of inflation has really gone down a lot. We may not get rate cuts anytime soon, but at least we probably will not get any more rate hikes, given that inflation is continuing to decline.
Now, speaking of the Fed, the Jackson Hole Summit is coming up. What do you think the language will be there?
I think the language will probably be more of, that we're making progress on inflation. It's not quite where we want it to be yet, but that because of the lags involved, we can afford to wait a little bit, and that the tightening that's already occurred will show up in the data in the coming months. I think they'll also, note the fact that bank lending has slowed dramatically, and that's another driver of inflation that potentially is depressing inflation. So I think they're probably going to still say that they're going to still watching it closely, and they may repeat the higher for longer idea. But I think that they'll probably start to back away from the idea of further rate hikes, given that real interest rates, meaning policy rates minus reported inflation, is relatively high right now and going to probably continue to go up. John Williams mentioned that recently in one of his interviews. So I think that's the messaging they'll probably roll out for Wyoming.
I see, I see. So, of course, we're obviously down from the peak inflation of 9.1% from last year. But how much do you think is a factor of the math, right? Just the math behind these year-over-year comparison. How much has that played in terms of inflation coming down?
Oh, that's right. Yeah, and the path of inflation over the last 2 or 3 years has been very unusual, and it's kind of thrown off, a lot of what the economists typically look for. Basically, from the middle of 2020 to the middle of 2022, we had a very large rise in prices overall in almost any index you use, CPI or anything else. And after that, it was really kind of stopped because once the Fed's tightening started to hit for mortgage rates and all that, and there was a peak in oil prices and other commodities after middle of 2022, everything except the housing costs, which we know are lagged, really kind of stopped going up in the U.S. And so what that causes was a big kind of peak or spike in the year-over-year inflation rate, and then we've now seen a steady downtrend from 9 to about 3% over the last 12 months. And so I think we're seeing that pattern play out in the year-over-year numbers, but watching the shorter term, say the 3-month or 6-month, has been a little more useful in terms of gauging the current trend because the data from 2022 essentially was very noisy and very extreme, and now we're getting back to more normal numbers, which I think we'll see going forward.
Because I'm wondering if the math is playing a big role. Are we going to see more of an uptick from this point on in inflation?
I don't know that we'll see a big uptick. I think the trend of steadily falling, going from 9 to 3%, has been a pretty steady decline. I think as we get here over the next few months, it will be a little more choppy in terms of the year-over-year numbers. We saw a bounce this month. It may tick down next month, but the numbers will probably kind of just slowly drift back towards the kind of 2 to 3% range, which is where I expect we'll probably end up, by year end. But it'll be a little more choppy just because the numbers will be dropping off some of the big numbers from last year, and then replacing them with more moderate numbers. But it could bounce around still month to month, given the way the CPI is calculated.
So it'll be basically more sticky.
Right. Yeah, kind of the easy part was going from 9 to 3. It'll be a little bumpier, probably getting from 3 to 2 or whatever it's going to end up. But I think the fact that the CPI excluding housing is already close to 0 right now, year over year, and the PPI, which will come out tomorrow, which people tend to pay less attention to because it comes out after the CPI, is also close to 0 year over year already. So those kind of tell me that, again, excluding the kind of lagged housing data, we're already pretty close to a very low or sub 2% inflation rate. So we could see a rebound a little bit, but even that wouldn't be too worrisome from my point of view, that we want inflation to be in this, 1 to 2 to 3% range generally over the longer term. And that's probably where we'll wind up. It'll just be a noisy kind of bumpy ride to get there.
Do you think, of course, the Fed wants a 2% inflation rate. Do you think as we get closer to 2%, it will become harder and harder? For example, if we have 2.1, it'll be very hard for it to come down to 2.0.
Yeah, and once you get kind of closer to those numbers, you really start to get kind of within measurement error, essentially. I mean, there's a lot of things in the CPI and other metrics that are, kind of variables that are hard to pin down with great precision. So once you get in that range, I think the Fed will probably take the view that we're close and we don't need to tighten any further. And in fact, may need to loosen a little bit in terms of bringing nominal rates down a little closer to where inflation is. That if you have a 5 or 5.25% Fed funds rate and you have a 2% inflation rate, that will be a 3% real rate, which would be quite high by historical standards and by the Fed's sort of normal standards. They would view that as excessively tight potentially. And so I think they might make an argument that you could come down to 4% or even 3.5% on the Fed funds rate and still be fairly tight. Still have positive real rates, but not as tight as they would be when you have a 2% inflation and 5+% policy rates.
Do you think the Fed will be happy with low 2 handle inflation rate? Do you think they will declare victory at that point?
I think so. I think if we get a sustained several months of those kind of readings, then they will be able to sort of say that they've reached their target of around 2%, particularly given that for the 10 or 15 years prior to COVID, they struggled to even get up to 2%. And so I think they'll probably consider something close to 2%, even if it's slightly above, to be well within the kind of range of error and to be considered a win, particularly if employment stays relatively firm, the unemployment rate stays relatively low. Having a 2-ish% inflation rate and low unemployment would be considered a sort of a dual win based on their mandate.
Do you think we're still going to have a recession? Because if you still think that we might have a recession 2024, 2025, is there a concern that inflation will actually drop down to around 1%?
Well, that's true. I think if we did start to see real recessionary signs next year, then the pressure on inflation would certainly be further down rather than up. Again, barring a big supply shock of some kind of oil or a war or something like that. And so I think there would be more impetus to cut rates and to try to stimulate a little bit more. The thing I think that's helping us really in this case is that fiscal policy remains fairly stimulative. It's fairly supportive of economic growth and things like infrastructure and construction of new factories and things in particular. And so I think that's going to help both in terms of supply, meaning there'll be more output, and in terms of jobs and general government. So I think that's going to help us avoid recession at least for a little while longer, unless fiscal policy changes dramatically. So I think the fact that we have relatively tight monetary policy but stimulative fiscal policy is a good balance, and one we haven't had in a long time in the U.S.
And maybe just one more question. What do you think the Fed is the most concerned about at this point?
I think the Fed is still concerned that that housing costs and things like that will stay elevated and keep that core rate up. I think they're also worried that that if inflation doesn't come down fast enough, then they'll be obliged to keep rates higher for longer and potentially provoke a recession sometime next year. I think they are concerned that they need to get inflation down, but they also don't want to damage the economy too much, and that monetary policy is already pretty tight, and I think they're worried that they're going to have longer term impacts of that next year or the year after if they don't not able to cut rates sometime next year. So I think they're kind of balancing their messaging. They want to fight inflation, but they don't want to fight it so hard that they become the cause of a recession.
Do you think the Fed is worried about the banking sector because some of the mid-sized ones, small-sized ones got downgraded recently? Do you think they're thinking about that?
I think they definitely are. I think that's part of been their concern is that a lot of the banks, particularly some of the smaller regional ones, are still under pressure from their balance sheets from what's happened to date. I think they're not less worried about a systemic bank run kind of crisis, but just that a lot of the banks are struggling and they're not going to be able to make loans to the same degree, and that's good up to a point. I mean, they want loan growth to slow, but they don't want it to go in reverse too far. And so I think the question will be is now that it's starting to really slow, is it going to go too far the other direction and banks become too tight with credit? I think so far they have not, but that's the risk that they're looking at. I think the big banks are generally okay. It's the smaller and regional banks they're more concerned about. But that's more of a regulatory concern than a monetary policy concern, I think, at this point.
Sure, of course. And thank you for your time today, Sam.
My pleasure. Thanks for having me.